Hello, my name is Tim Gregory. I'm from Vermeer Investment Management, and I hope everyone is managing to stay safe and friends and family are also able to cope with this continuing remarkable situation following the outbreak of the COVID-19 virus. Today I wanted to talk a little bit about the oil industry, which has been right at the epicenter of the problems that have been created by COVID-19. And in fact, there has been a double whammy in the oil industry, because as it became apparent that economies were going to have to close down for a time, the oil industry was also hit by a price war caused by a spat between Russia and Saudi Arabia, which suggested that there was going to be a considerable amount of supply coming onto the market just at a time when the economies could least afford it. Subsequent to that, there has been some sort of agreement that will limit supply, and hopefully we are beginning to see now the broad recovery of demand. And earlier this week was the beginning of the driving season, the traditional day in America where motorists take to their cars and the driving season takes place. And the oil price has seen a good recovery. WTI crude, having temporarily traded in negative territory, has recovered strongly and is now at around $34. And the Brent crude price is a little above that at 36. But the gap between those two has closed dramatically in recent weeks. Oil price stocks have recovered in terms of share prices to a degree, albeit that they remain fairly depressed overall. And actually, it's worth noting that prior to the lockdown and the dislocation for the economy, oil stocks were struggling because of ESG factors that a lot of investors do not want to invest in this space going forward. But there is still a lot of relevance to the sector. There are some major companies and some very good companies in the sector. And we think the focus of attention for investors should be on those companies with good quality assets, with good management, who are able to generate cash even at these depressed prices. And are able to remain in business, can continue to control capex, which they will do going forward, and generate cash and perhaps reward investors with dividends going forward. And we think that that is going to be the key to successful investment in the sector. We've seen a dramatic collapse in the rig count to record low levels, from over 1,000 down to around 350. That's the lowest since records began. And we expect capital expenditure budgets to continue to be constrained, which may continue to be a negative for the oil service industry. So I think that's an area to be a little careful of. However, there are, as I said before, some good companies in the sector. I think the right strategy is to focus on good managements, good production assets, good quality cash flows, and the possibilities that companies will be able to either maintain or grow dividends or even start to pay dividends to investors, particularly if the oil price is able to continue its recovery from here. And I don't really think that $35 is a price at which a huge amount of the industry will be sustainably profitable. So we need to see that price continue to go up as things normalise and perhaps move to $50 and above for the industry to maintain its recent better performance going forward. Thanks very much indeed for your time today. Once again, I hope everyone is able to stay safe and that their friends and family are also able to stay safe at this difficult time. Thank you so much. Bye.